I'm a little bit more optimistic about asset quality and the credit environment than I was a few months ago. For one, there is quite clearly an economic rebound in most of our markets. And you can see that coming through in indicators like loan demand, but also consumer spending in most of the countries. So that's obviously somewhat helpful. Commodity prices are on the up. Oil, in fact, has recovered quite nicely. So some sectors which were more vulnerable are showing better signs of strength. On the SME sector in particular, as you know, a large part of our loan book was under moratorium. But in the last few weeks, several of these moratoriums in many countries have come to an end. And while there are new moratorium schemes, what's happening is that a very small percentage of people are moving on to the new schemes. And that's actually not just SME, that also includes the mortgage moratorium. So in Singapore, for example, only less than 10% of the people have moved on to the new moratorium program. In Singapore SME, only about a quarter have moved to the new moratorium program. And in Hong Kong SME, about half have moved to the new moratorium program. And the people who have not moved to the new programs, the delinquency rates are quite low. So which means they are being able to service their debt. So that gives me some degree of comfort that in the SME space, in the individual space, things are not that bad. And finally, unsecured consumer credit. As you know, in the middle of the year, there was some sharp pickup in delinquencies in unsecured books in Indonesia, Taiwan, even Singapore. Even that came down quite markedly by the end of the year. So overall, I'm a little bit more optimistic. I think the credit outlook could be positive.
And what does that mean for your overall provisioning as of now, and also the possibility of write-backs, given that you were cautious last year?
Well, you're right. We were cautious last year. We took provisions of over $3 billion. If you remember, we had earlier guided for a 2-year cost of credit of somewhere between 3 and 5. And so the lower end of that 3 we've already provided for. Now, given my new outlook, I don't think we'll get anywhere near 5. If you get to 4, that means we'd have to take another $1 billion this year. And that would be par for the course. That's what we normally take in any normal year, somewhere around the $1 billion mark. Now, it is possible that we need even less than that. And, you know, therefore, the question of could you start reversing some of your general provisions is an appropriate question. I think it's unlikely that we'll see any reversal, certainly in the first half of the year. Maybe towards the end of the year. It's more likely that if there are any reversals at all, you'll probably see them coming through in subsequent years.